So of late, the diagnostic industry and its prospects have been subject to much debate by the investing community. The debate has been sparked by multiple factors. Factor A, the entry of online discounting players like Tata 1mg, Reliance Netmeds, etc. Factor B, the introduction of NLEDT, National List of Essential Diagnostic Tests, implying that there is potential pricing regulation coming in the industry. Factor C, the flat to declining revenue and margins that the companies are reporting like Dr. Lal, Metropolis, SRL, etc. And factor D, the significant fall in stock prices that have been led by multiple derating and relatively lower but sure earning cuts as well. When we launched our InCred Healthcare PMS in February of 2021, it was the midst of COVID. We had kept a very cautious stance on the diagnostic industry as a subsegment. The reason for the cautious stance was that the companies were earning significant one-time income from COVID-related tests, and yet the stocks were re-rating, implying much higher multiples being assigned to the core earnings. We were uncomfortable with such high multiples. Post-COVID, as earnings and revenues have normalized, the base business has now being valued less by the investors, as in the multiples have now come off. The declining multiples, despite normalization of earnings, is being looked at by us as an opportunity to increase allocation to the space. Now that the valuations are more reasonable, we are at InCred PMS becoming more positive on this subsegment. History suggests that the discounting online model has been unable to disrupt the space meaningfully. Take the example of Healthians, for instance, which introduced a discounted online platform in North India in 2014. As per the Ministry of Corporate Affairs data from that website, as of 2021, Healthians reported 70 crores of top line and 45 crore loss after tax. Hence, we can safely conclude that in this subsegment, the online platform discounted prices do not work as a customer acquisition strategy. Although NLEDT has been introduced, the premium pricing players are the one at risk in our view, as we have seen with NLEM. In NLEDT, even if pricing control is introduced, government is likely to take the average pricing of a given test by various large chains. And therefore, the chains which are today at premium pricing are more at risk in terms of facing price cuts than the chains who are at discounted prices. We at InCred PMS are increasing allocation in the diagnostic space in stocks like Thyrocare and Krishna, where the pricing is actually significantly lower than the premium pricing players, and hence, even if an average price were to come as a ceiling price, our holdings will be immune to such price caps. Both Thyrocare and Krishna have reported double-digit growth in core revenues and earnings, implying no pressure from fresh competition. These stocks have also become way more reasonably valued today than they were, let's say, a year or two back when there was a COVID environment. Our view remains that the industry is unlikely to be disrupted. By investing in discounted platforms, we are also sidestepping a potential price regulation. We now have a 11% weight in the diagnostic industry in our InCred Healthcare PMS portfolio versus 3% in the index. Thank you.